Ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry. And no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.
And it's the weekend once again. How are you doing, fellas? Welcome back for another weekly market recap. At the end of a week, which, it went as smooth as we could have expected. Pretty much everything came in or played out as forecasted. Not that it was, that hard. It doesn't take a fortune teller to tell you that markets which are generally all going up will keep on going up for at least, the foreseeable future, up until the point something changes, right? So from that point of view, pretty much smooth sailing throughout the week. We had a lot of economic data coming in, especially for the labor market. And I know it's a bit boring, but let's just to get rid of them as quick as we can. Now, we got services PMI, which came in positive. You could argue again, as we were kind of discussing for the manufacturing PMI, is this another peak like we have seen in this one? I mean, the last two prints were kind of a rollover compared to the highs in February 2026. You may say, yeah, sure, it could be the energy crisis, which is impacting a little bit the services sector because consumers are a bit worried when they look at the price of the gas pump. Maybe, but at the end of the day, if you think about this index right here, up until the point we are about 50, we are cool. So again, we came in at 53.6, so not bad. And again, if you want to dig deeper, for this one, as for all the rest, it would take some sort of a 2 hours long podcast. So I'm not going to dig a lot, but if you want to go deeper, just do it on your own. There are a lot that you can extrapolate out of this data, right? For the medium to long term, which is not really what we do care since we are looking at markets and data from 1 week to the next, or when it comes down to data from 1 month to the next. So, take it or leave it, I guess. Now, we also had JOLTS, job openings. And again, this is where the same as the economy, right? The K-shaped economy, even labor market data sometimes could be read as bifurcated. Because, if you look at this one in isolation, you may say, okay, so the economy is not creating new jobs. And this process is going ahead from basically the 2022, right? So how can it be that people keep on telling, oh, the economy is fine, the labor market is resilient and all the rest? Well, I mean, look, this one tells a story, but there are other data which are telling another. So probably the truth is in the middle, right? Same old saying like, but it's not all black and white. Sometimes it's a matter of shades of gray in the middle, right? So again, if you look at this one, it looks like, yeah, it wasn't that positive. But let's just say at this point, there were other offsetting factors, so to speak, right? So moving on, what we got is the jobless claims, which if you noticed, I didn't include in here for, I think, a month now. And I explained that for me, with the structural changes in the economy so far, I think these data set actually lost a little bit of efficacy. For example, just recapping it, today with the gig economy and all different type of jobs, they could lead you to maybe lose your main job, regular job or full-time job. But since you're doing these other jobs on the side, it might be that you are not qualifying for unemployment benefits, so you cannot claim them. But that doesn't mean that you're not making money, and therefore, although at the margins, being able to make ends meet, right? So I think, it's losing a bit of efficacy because of that. Broadly speaking, if you look at the raw data, if it's going down, that's cool. It means, less and less people are claiming unemployment benefits, which means that one way or the other, either they found a new job, they recycled themselves in the labor market, or they don't qualify. So, of course, one is better than the other, but these are the data. And same goes for the continuing jobless claims. So, as usual, if you apply for unemployment benefits 1 month, let's say next month you find a new job, you get out of those benefits, so you don't get counted in these data set right here. So if it goes down, it means that more and more people are coming off the jobless claims, benefits, whatever you. All right. So it should be taken as a positive. Again, with a big caveat of the beginning. Like I don't know how much I should trust jobless claims as a whole in this period. Right. Okay. Moving on, we got NFP. Oh, look at that. We came in. The data came in at 115Ks. Right. So good. Right. Good. It was a bit. Right? And you remember what I was saying last week? I was expecting a bit above 100K, although the forecast was for what? 62, I guess it was. So, and again, I'm not a fortune teller by any means, but it was just logical for me looking at the data that we were receiving back then and for the previous month. So, just gut feeling. Sometimes gut feeling can actually work. I think, for now, it's not bad. We still have the huge risk of revisions. And even, if you look at the recent history, the previous month data was revised higher. The data for February, I think it was revised a bit lower. So, you never know up until the point you know for sure, which is usually 3-6 months down the road after the first revision, the second round of revision. And then you have, basically March next year, you're going to have the huge revision for the year. So, it's lagging like a lot, which brings us back in the huge old debate. It's NFP reliable, or it would be better to rely on something else like ADP, right? I don't know at this point. What I do know, though, it's no matter what I think, right? No matter how flawed these data may be or the way they are collected, right, and calculated, the point is that the market will move on this data. And that's all I care about as a trader in the short term. If you're trying to really assess the health and the status of the American economy, okay, maybe you would need to dig a bit deeper. But for me, I can acknowledge the fact that something doesn't add up, but at the end of the day, I need to trade the market. And it doesn't matter what I think. If the market keeps on thinking these data are reliable or are just an excuse, a catalyst for moving up or down, I would need to accept that reality, and so be it. Okay. Now, we got what then? Average hourly earnings. And again, you can see that we are above. What the fuck is going on now? No, just a glitch in the browser, it looks like. But we are above pre-pandemic levels, but still, after the 2022 high, we are rolling over a little bit. It's not critical, we are still above those levels. And if the economy was running kind of good in 2019 and before the pandemic shock, one would just assume, if we are above those levels now, it means that we suffered the crisis, we came back, and we are now better than what we were before. At first glance, it may be, but we are just slightly above those levels, right? But in this period, from 21, 22, we had a huge inflationary spike. And the thing about inflation is that it doesn't stop. It doesn't come back. Let's put it this way. Like if for a year or a year and a half, something like it, we got inflation above 6-7%, those price increases are not going to be reverted, right? Maybe the pace at which prices are going up now, it's lower than what it was back then. But just because inflation or the rate of inflation is coming down, it doesn't mean that prices are actually coming down. They're just going up slower compared to before. So if you look at the hourly earnings, did they really keep up with that? Or did consumers or workers actually lost purchasing power in this period right here, this 5 years period, let's call it? I would err on the side they lost purchasing power, but, not enough, apparently, to stop consumption. So again, consumers can be very creative. They can find new ways to grab the money they need to keep spending, right? And plus, the government could help with, all the things we've seen, massive stimulus, helicopter money, checks in the post mail, buy now, pay later, a lot of stuff, right? So up until the point it doesn't end, it's hard to call for a crash in the economy or for a crack or for a major recession, right? It doesn't mean this is a positive. Maybe it just means that, the frog is boiling up very, very slowly, month by month, year by year. But that doesn't mean that it's completely dead yet. It doesn't even mean it will be dead someday in the future. We don't know, right? But, you could just infer something like this. It's not positive over the long run, but it's not these days, right? It's not enough negative today to impact the overall economy as a whole, right? And then what average weekly hours, again, this time around, instead, they are below pre-pandemic levels. So I would take it more as a negative than as a positive, right? So as you can see, if you start back from the JOLTS and then NFP and then these data right here, and then you move, let's say, to the labor force participation, which is going down, that's another negative. So, you go ups and downs, right? But if you look at the unemployment rate, you see it's relatively stable at the same levels it was in 2017, 18, 19. So pre-pandemic. Maybe slightly above it right now, but, you got the gist of it. Some may say, and I would tend to agree, that really the U6 unemployment rate, it's the one which is a bit more comprehensive and it gives you a much better picture of reality. Well, okay, but even in this case, the figures are a bit higher. But again, if you compare them to pre-pandemic levels, we are kind of in that range, all right? So, we were hovering around 7 point something percent back then, and we are around 8, low 8% right now. So not a huge change, or at least, it's not a drastic enough change, or it's not a fast enough change to actually trigger a recession, all right? So these were the data for the week, all right? If you look at the break-evens, just quickly, they came down a tiny bit. We still have this delta in between them. I think it's narrowing down compared to where it was, let's say, at the beginning of April. But still, the trend is up, right? So still inflation expectation seems to be a bit higher, right? Which, again, read it as you want. It could impact what consumers will do, how they will behave, or how the Fed will behave when it comes down to monetary policy. And therefore, it could impact the amount of liquidity present in markets, or it could impact credit availability, aka, again, liquidity, since money is credit, right? But we've been looking at this chart for ages now. Nothing seems to change. The trend is still up for now. Although, again, I think over the long run, we may see a little bit of trend reversion in this one, but give it time, right? It's hard to see it if oil is still trading around $100 per barrel, right? That's the expectations that consumers are trying to price in. Markets are doing the same, and even the Fed, I think, is doing the same, right? Still same data on inflation. You have been hearing me talking a lot these ones for weeks now, so I'm just going to present the chart, and you can make up your own mind if it is good or bad, right? Same for true inflation when it comes down to CPI and PCE, right? So other than that, I think, if you look, Fed Watch tool, same stuff, probably no cut at the next meeting, although we are still, 5 weeks away, so doesn't really mean shit for now. Credit spreads still relatively low. Overall, if you look at the broad index that you can find on the Fed database, I know there are many others, right? It depends on the instruments that you are comparing to each other. It depends on the duration and all the rest. But this is kind of the main one, which is usually not the one which tells you the whole story, or it's not where the story, if there is one, actually begins. But, again, I'm circling back. it would take 2 hours to talk about everything that would need to be mentioned, right? So I guess this is more than enough for now. Let's move on to the charts at this point. All right. Talking about charts, I think the few, the initial ones, they're not going to be so interesting because not a lot actually changed. Like for instance, the DXY, we were looking at these 2 levels and price being boxed in between these old support, broken, then confirmed as resistance now. And the support tested, bounced, tested again. What's going to happen now? That was basically the assessment last week. So neutral up until the point we can break out of this level. Now, it looks like all in all, the week kept on drifting to the downside. But again, I mean, look how many weeks we got into this pocket. And every time it was a bounce. You could argue, and I would agree with you, first one, bounce. Second one, bounce, but, much smaller than the previous one. And now we are testing back in it, and we managed to close, around the lows. So does it mean weakness? Yeah, I guess you could say that. But up until the point these fractal completely gives in, right? So to speak, it would be something like this at this point. Get back into this range, right? Maybe you have another bounce in here, right? And when you actually crack this and you leave below it, then the odds of the DXY going actually down and down a bit more could increase. But, I just see it as very rangy behavior, very choppy. And again, if you look at the past months, we are still trading in between these lows, these highs, and we are now back kind of in the middle of that. So I can't make up my mind on the DXY, right? It's just, I think fundamentally, if things go well overall in the world, these should keep on drifting down. Because usually when you see it spike into the upside, it's when something is breaking apart, right? So, take it as you like, but I would say for now, in the grand, scheme of things, nothing really changes up until the point we are below 100, but still above 95. It's a huge range. I mean, I'm not saying it's not tradable, but it's, to me, it doesn't really give a lot of indications up until the point it stays in here, right? So when you look at the other foreign currencies, for instance, you see the euro, which tried to reaccumulate at these levels and pushing back into these, old kind of short-term top that we put in, right? Still the same type of relative strength changed compared to the British pound. You remember we were looking at this segment right here, right? And now we're looking at these where the British pound actually made already new highs in this context, right? A new high relative to this one, while the euro, for now, it didn't. So bit of a relative weakness compared to the British pound. The dollar Canadian, I mean, it went up, sure, but this week it came back down a tiny bit. Isn't it ironic? It behaved a bit with an inverse correlation compared to the rest, right? Because you see the DXY going down, the euro up, the Swiss franc is up, the British pound is up, and the yen is up. The dollar Canadian was down pretty much all week. Curious. But, nonetheless, we just tested back into the highs. Is this one a lower high compared to this one, to this one, to this one? So we're going up, right? Every single pullback was a buy the dip opportunity up until the point we start this distribution. We test back into a previous support. We come back up, but we cannot have continuation to the upside. And actually, we make a lower high relatively to this previous distribution, which originated the first dump in the first place. Is it good or bad? Sadly, too early to tell. that would be it. I mean, again, This level right here, it's support up until the point it's not. And it looks like this area right here is resistance up until the point it's not. All things considered, if you look, if you zoom out a little bit, in the very short term, so let's say next week, I would be neutral on this one, right? I would be kind of neutral on a lot of different stuff when it comes down to currencies, but, the dollar Canadian, it's kind of like the prime example of it. Now, the Japanese yen, I think, again, they did another intervention in here, I do believe. I mean, it's not just the shape of the candle, but I was reading about it. So they threw in another, 30 billions maybe, in order to rescue the yen, which, I mean, I get it. Look, first of all, the move was coordinated with the US, right? It's very unlikely for me to think that a BOJ could go ahead with something like that without at least, making a phone call to Washington saying, look, we're going to do that. So, you're not necessarily asking if you agree or if you would forbid us to do it, but just saying if on your end you would need to adjust a few things to, let's make sure that we don't disrupt capital flows a lot in the FX market. But we need to do that now. So, be ready to assist in case we got some discrepancies or distraction or disruptions, right? So if they did it, most likely the US was aware, same as most likely it was aware the Bank of England and even the ECB, right? So all the Western powers, so to speak, all right? Again, I keep on thinking that these interventions, they don't last longer if they don't have a fundamental driver behind them. They're just temporary measures, right? But, if the market keeps on thinking that this thing needs to go down, right? I think, it's like, I mean, if you cut off your jugular, right? Would you think you can fix it with a patch? No, you would need something better than that, right? So I think it's kind of the same thing right here, right? If the market truly wants to see the yen going lower, it will go lower. No matter what, the BOJ, in coordination with the Fed, it doesn't really matter for me, right? Same old talks. The other currencies, I mean, a lot of the same. Brazilian real, stronger than ever. Indian rupee, weaker than ever. Chinese yuan keeps on drifting to the upside. Right? Good for them, I guess. Is it good for them or it's not so good for them? I mean, if your nation is a powerhouse, an industrial powerhouse, and you basically rely on exporting and flooding the world with everything you can think of, I mean, you would like your currency to go down relative to the rest so that it's even more advantageous to buy your stuff. If your currency goes up, doesn't it disincentivize people in buying your things because all of a sudden they are more expensive when you account for the FX exchange rate? Although, I mean, we are talking small numbers, sure, and all things considered, I mean, if you think, even 2022, right? Is it buying things from China really much more expensive now compared to then? No. But yet again, I think again, it's not something that you would necessarily like to see. It's kind of, I mean, if you think about it, it's kind of the opposite of what the United States would like to do, right? I mean, Trump would like to see the dollar going lower in order to favor and to boost US exports. The Chinese would like to see the Chinese yuan keep on staying relatively low in order to keep on boosting their exports. And now we are in a situation where the DXY is coming off of a huge run-up in the previous years. And the Chinese yuan, it's coming up of a huge run down in the previous year. So, I mean, at the end of the day, I think all the things are just rebalancing themselves out after the huge distortions that we've seen throughout the pandemic, the energy crisis in Russia, and most likely what we are observing now in Iran. But I do believe currencies naturally they would tend to stay in a range, right? Because at the end of the day, they are just tools that the state or the government they use it in order to balance out trades imbalances, right? So, I mean, they are kind of the king of mean reversion in my view, unless again there are structural reasons for something like the India rupee to go down only, or what else we could look at. Don't have enough here, which is really going on to a trend, but you got the gist of it. Or again, the Japanese yen, right? Going down and down and down. So I think at the end of the day, that's just it. But naturally, if you let them trade as they should tend to move in tiny ranges. And sometimes having this huge repricing one way or the other, right? So, that would be it for currencies. Let's have a look instead at yields, treasury yields. Not a lot to say. I mean, it's basically the same picture as last week. The short end still a bit weaker compared to the medium end and the long end. At the long end, we pulled back from big figure, 5% in here. We got back to, we spiked back down into 4.9. So, that was a huge move, all things considered, for the long end. But it looks like the trend seems to be to the upside yet. Again, it's slow grinding. This is how yields should move in normal situations, right? Kind of like currencies. And higher for longer maybe will be much higher for longer, in the sense that we see yields spiking to 6, 7, 8%. I'm still skeptical about it. I can just acknowledge the fact that we are actually staying higher for longer compared to where we're coming from. Not too long, right? Not too long ago, like think about 4 or 5 years ago, we had these yields below 3.5, 3%, 2.5%. So, having them now around 5, or almost 5, it's kind of double up, right? So, can't deny the fact that they're staying higher for longer, right? But much higher? I don't know. And I was vastly underestimating how low we were, because now that I zoom out, well, fuck 2.5%, we were below 1%, all right? So in 2020, sure, yeah, it was a huge jump, of course. But again, if you zoom out, you see the same, right? Short end drifting down, it looks like. Medium end, or the belly of the curve, staying relatively flat. And the long end going up. I think, it's not just inflation expectations. Think about the mechanics of it. Put yourself, especially if you're American and you constantly listen to people like Luke Groman, right? Which is calling for the American demise for ages now, same as Ray Dalio and others. But I guess they had a point when they imagined the US with higher yields for a much, long period of time. Okay. But I think sometimes they do get the catalyst or the driver, the underlying driver wrong. Because put yourself in the shoes of someone or of a foreigner, right? Let's take me. Let's put it this way. I am my own government. How cool would it be, right? I would do a shitload of different things, right? First of all, would be killing the Green Deal in Europe, but, without derailing from the conversation. Now, if I'm a foreigner and I see yields going up, and throughout the years, previous decades even, I maybe accumulated a lot of long duration treasuries. And I'm now stuck in something which is still yielding me less than 2%, right? Maybe. At a point, although I would lose a good chunk of money in the transaction if I sell treasuries at a loss at this point, but if I'm expecting rates to be higher for longer, or if I want to de-risk my positions, or if I want to transition my positions from something which is particularly illiquid, because no matter what you say, off-the-run treasuries, like long-dated treasuries, they are not as liquid as the 2 years, or maybe T-bills, right? And now I could do that. I get rid of these, and maybe I buy these, or something even shorter in duration, like 3 months bills in money market funds. Because of what? It gives me more flexibility. So in the short term, I'm collecting a yield which is kind of like triple or quadruple what I would keep on collecting on my long bonds if I hold them. And I have the flexibility to accessing the repo market and to, rolling that new tranche of my portfolio every 3 months, every single quarter. And I'm not tied to something that locks me in for a long period of time. And now I'm subject to sudden, hikes or drops in interest rates. I mean, it sounds stupid. I get it. The big counter argument would be, yeah, sure, but a government wouldn't change the composition of the portfolio in such a short period of time, taking such a huge loss by doing these transactions. If you sell out all your long-dated reserves, right, you are selling them at a massive discount now relative to, the moment you purchase them. Yeah. So the point would be, okay, is it something that I'm doing because I think it's convenient, or it is something that I'm doing because I think I'm forced to? I mean, sure, if I wait for another, I don't know how much it could be that I still have to wait before maturity, but let's say I got 30 years treasury bonds and I'm halfway through the duration. So I got another 15 years before I can recover the principal. So the assessment would be, do I think the next 15 years would be, calm enough to allow me to wait to maturity? Or do I think I'm probably going to face liquidity issues and I'm going to need to be quick to react and flexible in my behavior and reassessment and repositioning to support my local markets, my local economy? And therefore, taking this hit now may be a tactical move. I take the hit now, but I'm way more able to intervene in what I do need to intervene into the future. Now, that depends on what you think about geopolitics and how the world will look like over the next 10, 15 years, I guess. But when you start to look at that from that perspective, I think it's not that stupid anymore. It's costly, sure, but I guess costly and stupid are two different things. And again, it's all relative. You could assume it's costly, but what is the cost of keep on staying there and being paralyzed for the next 10 years? When it comes down to your ability, your, let's call it, range of movement or interventions for the next 10 years. So I don't really know, but I would think that at least a few people way smarter than me would have thought about it. Like, I mean, even China, right? So, I think what you've seen in China and all those Twitter posts, look at the amount that the Chinese sold out. Sure, they sold out a lot. They needed the money. Yeah, that's true. They wanted to diversify. Maybe they bought a lot of gold. And then you find out they also bought a lot of new treasuries, new issued treasuries. They're just holding them in Belgium and Luxembourg. But they still hold them. And maybe they changed the duration. So who knows, right? Like, if China did it, and you would run under the assumption that China is not completely stupid, quite the opposite. would you think other governments wouldn't do that? I mean, I don't know. I'm just throwing darts. Maybe I'm just trying to think about it. But again, it's another one of those things where I wouldn't be surprised, right? Now, conversely, the bonds, they rebounded a little bit this week. It's not huge. We basically bounced from a previous area of support, apparently, because we already bounced from here, right? So what's that? Is it double bottom and now we go up? Hard to believe at this current moment in time. It still looks like, you know, a market which is going down, huge bounce, comes back down, bounce, comes back down. The simple thing would be, let's wait for a relevant high to be taken out, like this one maybe, right? For the 10-year, this one for the long bond, and this one for the T-notes. Otherwise, you should just assume the trend will keep on being to the downside for now, all right? So, after bonds and a lot of jabber about currencies, kind of a geopolitics in there, and state balance sheet, let's move on to something which is a bit more juicy. For instance, Bitcoin, which again, it's another one which behaved pretty much as expected, right? As you can see in here, we are operating on a framework which is going like higher highs, higher lows. So, you know, up until the point that doesn't break, I would think, again, as I said last week, look, if the broad market is still risk on, there is no reason to expect this one to fall apart. We discussed about moving your point of invalidation from this low right here as a structural point up to this one, which I mean, quite honestly, doesn't change a lot. It's like 73,700 up to what? 75,000 even. So, you know, for Bitcoin, that's not a lot, but structurally, it may make a difference. And now, you know, we pushed to new highs once again, and we are now living above these levels. You remember that we were pushing and grinding into it, and we are above it now. So far, it's a bit early, but so far it looks like we kind of wicked back down in it, kind of retesting, flip, or trying to confirm a potential flip from resistance to support. It's holding for now. I wouldn't trust the weekend a lot, so probably better to assess it throughout actual market trading hours globally. But I mean, as usual, new highs are always encouraging if you do believe in an uptrend. So the thing would be, okay, where do you put your next invalidation point? Let's say if you're long in it, leverage long, maybe you bought a few contracts on the futures, you want to swing trade that, okay? How do you know you're wrong or something is changing? Because there is no dip swing low in this segment right here where you could trail your stop behind. So what do? Do you use this level? Like, for instance, we tapped into it a lot. Now we finally reclaim that. And it looks like we are retesting it now, okay? So up until the point we can live above it, I should keep on being bullish, right? So would expect the market to keep on going higher and higher. But maybe not that parabolically, but you got it. And what happens if, you know, we bounce, and then we fail the bounce, we make a lower high, and then we crack back below the level. So was it just a deviation above it, quick look above and fail? And if we start to leave back below it, now what do? Do I reduce my risk? Do I take partial profits? And I keep on maintaining my overall invalidation point below this low? That could be something you could do. Like, I mean, I de-risk if we get back below this level, and then I just watch and wait, right? Then again, if from here, right, we can, it doesn't really add up, but after that, we can really get back above the level and staying above it. I may re-add when we reclaim that again, but, you know, wouldn't be unwise to manage your positions. Like scaling in and out, at the end of the day, it's not bad. It just keeps you kind of safe. Like you take profits when the market is going in your favor. You replenish your drying powder money bag, and you put money back to work when the market is kind of pulling back. Yeah, sure, you could do that, I guess. Did we hit anything relevant on this last run up? Let's have a look at the past. I mean, I don't have it marked out, but if you really want to be picky, we got this pocket right in here. It's more of an area than an actual level, but imagine this point of release right here, up to these here. So I'm going to tell you how I define it. So you have in this segment right here, okay, you have this spike to the downside, which was originated by this point of release right in here. So the open of this candle here, and you see the market going down, coming back up, testing back in it, right here, right? This spike, rejection, but rejection doesn't originate new lows. Market reaccumulates, comes back up, trade above this point of release, which again, it was in control of the move down. Then it moves above it, closes above it, tests it back in it, right? So now you know that this area overall, this gray area, is a relevant area, right? Because it acted as a pivot in the past. Now, if you project that into the current price action, you see that, sure, I mean, on this spike was traded through, obviously, huge spike in volatility throughout this dump. But after that, it was kind of respected. Like, it was kind of respected in here, then in here, tiny little bounce before the further flush. So now we reacted back to it. I mean, is it a lot? Is it a nothing burger? Maybe, who knows? I'm just saying, sometimes the market tends to have a memory, right? And unless there is a huge spike in volatility under normal conditions and circumstances, the market tends to remember what it did before and when and where it did it. Okay, so I would say it's no surprise to see this rejection at these levels or this area. We could be temporary, right? Again, okay, and and after that we'll see what's come up. Should run off of the assumption that we still need to lean bullish. All right, for now, there's nothing which is indicating that we are due for a massive pullback, right? Especially up until the point we are above 79, let's call it, right? And most importantly, up until the point we are above 75 at this point. So, it's a huge range for invalidation, like 5K, but it's still Bitcoin, so you need to adjust to the volatility of the asset, right? Let's have a look instead at gold. Gold, which is another one which played out as intended. We were looking at, we were in here, right? So we already kind of tested this area, this whole fractal, this whole base, right? We discussed about the fractal nature of this redistribution and the bounce, and this redistribution and the bounce. What we anticipated was, look, up until the point this area doesn't crack, it's all well and good, right? Would it be unusual to see a farther, maybe deeper test in it before the actual bounce? No. Case in point. Monday, tested back below it, right? Below this low, and a bit deeper into the area, and we bounced off of it. And the rest of the week for gold was particularly cool, right? So, another example of a market which could, sometimes things just play out exactly as you expected them to play out. Hey, it's more, it's more the exception than the rule, but sometimes the market is just clean like that. So, embrace it up until the point it lasts, because I'm gonna tell you, it's gonna last for a while, or for a while longer than what you could imagine. Like, sometimes it looks like the market is moving like clockwork, right? And it may do it for 1 week, 2 weeks, 3 weeks. Just when you start to think that at this point you have it all figured out and the market will always do this and that, at this level or the other just because it did it over the last 2-3 weeks. And then something happens, a catalyst comes in, a piece of news, a headline, an event, and the market goes high wire again, and it gets a hell of a lot more volatile. And these levels, instead of being respected to the T, as you've seen this time around, they tend to be a more iffy, and you get back to treat them more like an area rather than straight lines. Such is the nature of the market, whether you believe it or not. So, for now, gold, I would say, we are in phase 2, so to speak, right? Because the phase 1 was looking at this bounce, maybe deeper retest, but still expecting a bounce, right? And the phase 2, so the second stage of the reasoning, of the logic, was then we see what happens at these levels right here. Do we see another rejection? Therefore, at that point, we should start to expect we get rejected in here, that we establish a new dealing range in here, right? Can we see it tapping it, being rejected initially, and then, higher low, tapping it again, and finally breaking it and reclaiming it? Then, at this point, it's where you start to think about targeting what? The next level. You have one right in here, which is, reacted to in the past. And after that, which, again, was tapped in what? Almost once, twice, 3 times. So probabilities would tell you maybe we test a bit deeper if we can actually reclaim this level right here at this point. May take, a week or two. It doesn't have to happen all in one day, but the path of least resistance would be to the upside at that point, right? So, this is kind of where I am with gold for now. Neutral, but, after this bounce, a bit more bullish oriented, but still, I need to say neutral because I need to see this level being reclaimed and potentially these highs being traded above, right? But, at the very least, what you could say is, look, we had a high, a low, lower high, lower low, lower high. Are we working on a higher high now, here, relative to here? So what do you need in order to confirm a trend reversion and therefore continuation to the upside? You kind of have your higher low in place right here. So what you need now is a higher high, right? It's just the simple things at the end of the day. The other metals, copper kept on being the strongest. It was already the strongest. I don't know, palladium and platinum, they didn't follow along with gold like a lot, especially palladium right here. Platinum, yeah, the week was good overall. It was a positive week, right? All things considered. Silver reacted very good in the sense that it went up together with gold, right? So good for silver, I would say. Still, actually silver, it's a bit closer than gold to trade above this high right here. Although, again, I should say, and this may sound like crap or nuances, but the high, let me check back on gold. It's not really the same. The structure is different. But look, this is a high, kind of like you have in gold, which you would need to reclaim, right? In order to confirm, high, lower low, even on a closing base, right? Lower high, higher low. Now you would need a higher high. True, but I was moving back and forward from gold to silver because I would like to see one thing, which may be relevant in the sense that if you look at gold, and then you look at this high right here, right? And if you look at silver, you look at the same high we were looking at for gold, this one, right? And silver would be this one. And then you look at this high, kind of like we did in gold. Find the next high. Why am I doing that? It's just, it's not strictly a hard rule which cannot be broken, right? It's more of a, definitive type of confirmation type of tool. But when it comes down to assessing the long-term trend of something, which doesn't have anything to do with what could happen intra-week, right? Intra-week, it could go up, down, sideways, whatever. Okay. But if you think about putting on positions for the long term, so 3, 6 months out, 1 year out, okay, I like to look at what was, or which was, the last high, right, in here, which originated what? The lower low, right? Because that's what I would define as a structural high, as a key high, as a key swing. All that we see in between here and here, so in this dealing range, that's all internal liquidity alone. And again, people may ask, okay, what is internal liquidity versus external liquidity? It's just, when you have this leg, right? You have a leg down. Up until the point, you either get continuation below these lows, so trend continuation down, or trend reversal, so trading and closing above the high, which was responsible for the last continuation lower. All of these in between, you're just trading internally in this dealing range, which was established when the market was repriced from this high back down to these lows, right? So it's totally possible at the end of the day that we could, again, talk about this high, failing, coming back toward the lows in here, right? Here, right? And then what? Maybe we sweep these lows and we have another mean reversion back to, the middle overall of the consolidation right here. So I'm just trying to leave all the doors open, right? Trying to forecast all the potential scenarios. But, short term, again, if you reclaim this high, you should at least get back to test this one. But I would think for the long term, this one, it's the one which is in control. And it's the one that you would need to retake in order to really be particularly positive on the long term, right? So just a little bit of a caveat, maybe. It might be just a technicality. It might be just nuance, but, why not? At the end of the day, this is what technical analysis is. It is a lot of nuances and technicalities. It's an imperfect tool, right? Technical analysis is not the Bible. Like if you think that just because you studied technical analysis, you're able now to forecast what the market will do in the future with, 99% accuracy. Yeah, forget it. It's just another tool to build up some sort of a statistical edge, but statistics are not absolute truths, right? So, this is why I get lost in the nuances more often than not. And look, it might sound like a fool errand, or a waste of time. But I'm gonna tell you, over the last 8 years, nuances actually saved my butt a lot of times, right? Whether it was, to manage my risk or to not take positions I wasn't particularly sure about, or even, letting the proverbial runners to keep on running. So it is something which could help you out, all things considered. Now let's have a look. Let's move along. Let's have a look at oil. And again, played out as intended. We have been discussing 95, so the EQ of the range, being kind of like a magnet. And it looks like this week was no different, right? Let's zoom in a little bit. Okay, so what you see, we closed last week above range high, right? The wick opened up. We ran up a little bit, and then what? The bounce failed. We got back below in here, range high, right? Tested back in it, and then down we went. Huge spike. I think that was because of what peace talks and whatnot. At this point, the news stream, especially for oil, it's so impactful that every time you see a move, you're always like scrambling for saying, oh, what happened? What's the headline, right? But, nonetheless, at the very end of the day, we gravitated back toward the EQ. Didn't need to be exact, could have been 95, 93, 98, but in that region. And as you can see, we were particularly volatile. Like the initial spike went down to 88, right? Then we went back up to 97, then back down again to 90, and then back up again to 98. So, I mean, like these are $7, $8, $9 swings in the price of oil in the span of hours. So again, it's a market where you can make a lot of money very quickly, or you can lose a lot of money very quickly. All right. So, what matters for me is that at the end of the day, at the end of the week, in this case, we gravitated back toward the EQ. So, it's like you may start to think about these markets, all markets, to truth be told, but think about them as an auction, right? What are you having here? You have, let's start from the lower side, okay? You have sellers pushing price lower, selling and selling and selling, right? And then you got buyers stepping in and saying, you know what? We think that at this price, this market is cheap. So we're going to buy it up. All right, and the market rebounds, keeps on going higher. Then you get into these levels. So at this point, anything about really 107, 106, right? You get to these levels and you have buyers keep on buying, saying, oh, we keep on buying, right? And then you got sellers stepping in saying, you know what? We sellers, we do think at these levels, this market is expensive. It's trading at a premium. So we are willing to sell it. And therefore, what? The market mean revert and goes back down. And you have these kind of a sweet spot, right? When you see the market price action, it's staying relatively quiet compared to this segment, or this segment, right? So that's kind of where you have a lot more of agreement in between buyers and sellers, which creates what? A balance, which is what? A fair price. There are a hell of a lot more of market participants in this area gravitating around this orange line, which is willing to say, yeah, this is where we want to transact, because this is where we think price is fair enough. As for, sellers willing to sell and buyers willing to buy. Everything which deviates from these kind of a epicenter right here, so to speak, it's quickly bought up or sold off. So, that's it at the end of the day. This is why this range has worked out so perfectly over the past, really a month at this point. More than a month, was the beginning of March, right? So, that would be oil. Now, and a funny anecdote about oil. Now, do you remember we were thinking about the future of the price of oil, when things get back to normal, should you expect a collapse in the price of oil? And even in there, we have different stories, right? When it comes down to the price of oil, gas, commodities as a whole, right? The first one would be this one. Look, now, this is basically the recount in the US, because the narrative would be, okay, if the price of oil basically doubled in the last few months, right, that should incentivize a lot of people, right, in doing more investment. So opening up new oil rig platforms, offshore platforms, right? Or maybe digging in for new wells, right? But what you see is that the rig count, it's not going up. It's staying relatively flat. So it's kind of like, in this case, we're just looking at the US, okay? But it's kind of like they're saying, look, you know what? It would take a lot of money to bring on new infrastructure and to start, drilling for new wells, right? So the point is that for now, we do not think that's convenient for us, because the risk we are seeing is that a piece of news, a headline, piece made in the Middle East, the the price of oil collapsed and we basically deployed money, we are not going to be able to recover if the price of oil collapsed back below, I don't know, 60. At that point, the investment won't pay for itself. And again, it takes what? From 4 to 6 months to bring on a new oil wells. So is it in your best interest to do that? While if you keep on maintaining your current level of infrastructure and production, you can vastly increase your profit margins because you are selling a barrel of oil for double the price it was before. So I think the dynamic is twofold here, right? On one side, you are keeping on making a lot of money because oil is higher. The price of a barrel of oil is higher now. On the other hand, you're not taking the risk of deploying and invest a lot of money now because you're not sure about the price of oil 4 or 6 months down the road, right? And again, do you remember last week we were looking at the price of oil, the December futures, right? It's already trading in the 80s, right? So again, the market doesn't expect the price of oil to keep on being at these elevated prices for, from here to year end. And therefore, since we are now in May, also the producers are saying, well, oh, look, if the market itself doesn't think this is going to last, why should I deploy money now, right? While I can keep on doing more money by doing nothing. And again, if you look at what, it is just one, right? But you could assume it's kind of the same logic a lot of other producers would apply. We are talking about Diamondback Energy right here. So they are talking about Duke or DUC, but drilled but uncompleted. So we're talking about wells which they already digged in, right? But, it's kind of like they did 90% of the job, but they didn't do the remaining 10% to make the wells operational, right? So rather than investing in new oil rigs, new platforms, what do they say is, we got this almost finished job in here. So if we need to ramp up production with the minimum effort, we could be completing these, wells that we got available already and ramp up production. So we don't need to spend a hell of a lot more in new infrastructure or new offshore platforms when we kind of achieve the same result by simply doing these. Minimal cost, maximum output, maximum profit, right? So they can have a fast response when it comes down to ramping up production, but at the same time, they wouldn't have to be so dependent on the fluctuations of the price of oil over the next 3, 4, 5, 6 months, right? So again, it's just another dynamic. Now again, when you think about the price of oil over the long run, right? Again, we're getting back to, it's not really technical analysis, it's more of a fundamental backdrop, I think. But a lot of people may talk about these commodity super cycle. All right. Now look, just a hint, because again, it's another one of those things where you would need to talk for hours, maybe, because when you think about a commodity super cycle, you need to factor in many different things, from global macro to different nations and what they're doing. Just for instance, the last commodity super cycle was originated starting from the early 2000s, right, really, by China urbanizing itself. A lot of people in a country which counts more than 1 billion moving from, the countryside into the cities. So infrastructure was needed to be built out from scratch. Talking about roads, bridges, cities, schools, highways, airports, you name it. That includes not only oil, but includes, concrete, copper, aluminum, iron, steel, you name it. Okay. So that originated a commodity super cycle. But now, is there really a country in the world which would go through a phase of urbanization like that, which could trigger it? And that would be one thing. Then, of course, you have the talks about the over or under investment. So, and then you have global demand, global economy. It's a lot to be packed in all together. But just for, frame of reference, right? I mean, if you have a look at this, right, and you say, okay, so look, you think commodities will be up. Okay, so if commodities are going up in price because, there was an underinvestment in, the producers or the miners, right? They won't be able to face demand. So price will need to go up. Okay, so if price goes up, input costs are rising. So there is more inflation. Now, just remember that when input costs are rising, they're not only rising for you or for the other businesses in the economy. It is also more expensive to drill for more commodities. Because drilling, ironically, requires energy. Okay? So there is a point where those profit margins stops going up. Okay? And then again, if you have inflationary pressures, most likely the Fed holds rates higher, which brings to what? Tighter financial conditions. If you got tighter financial conditions, what you got is growth slows down because you don't have enough new money, new credit, new money creation to fund future growth. So growth slows down, right? If growth slows down, both the consumers and the corporations are squeezed. What do? They start spending and consuming less. But if they spend and consume less, they would need less of what? Energy, aka commodities. So demand for commodities would fall in a moment where input costs for those commodities being digged out of the ground, it's going up. So that further erodes those profit margins. So it's not, it's not a good investment anymore, maybe. And then again, you got demand falling. And therefore, the rally initially originated in commodities tends to be faded. So again, this is why they call it a self-defeating type of logic. Because it's not just about the investment or underinvestment dynamic in the commodity space. It's not just a story of demand and supply in the short term, but in order to have a real super cycle, you would need to have a lot of different pieces of the puzzle, all falling in the same place, all together at the same time. And you need that perfect storm. And again, China urbanizing itself was a really good example of that. And we don't know if we have some catalysts like that right here, right now. People talk about India. Well, look, if you look at the data, even the projections for India, if they could keep on growing at the pace they are growing now, it wouldn't come close to what China did from the early 2000s up to the 2010s or whatever. So, I don't think it's a fair comparison. All right. So again, just tiny little bit. And look, just to close it in, when you think about this is basically the spot commodities is some sort of an index, right? When you adjust it for inflation, what you see is that commodities, again, adjusted for inflation, right? They're actually going down. And if you look at the average, every time we are above it, we get back to it, and then we go below it, come above it, mean reversion toward it, above it, below it, above it, below it. Now we're going above it, most likely. So who tells you that in the future we are not getting back below it once again? And all of this, again, I should repeat itself. I should repeat myself. It is inflation adjusted. And you may say, well, okay, that's like rigging the game. It doesn't tell you a lot about nominal prices. Well, it actually tells you a lot. Because it doesn't really matter if we are talking commodities or we are talking about your portfolio returns, right? If you don't adjust it for inflation, it's not real. I mean, your portfolio could go up 50%, right? what if inflation, aka the cost of living, goes up 70%? Are you actually making money? Sure, nominally your portfolio is growing, but are you actually making money? No. Because then when you have to go in the real economy to buy the stuff you need in order to survive, you're buying them at a 70% premium compared to where you were buying before you structure your portfolio. So you're actually losing money, which is why adjusting for inflation counts a lot. And it tells a lot of stories that the nominal data don't tell you, right? It was a bit too long, maybe, but yeah, I mean, such is the nature of me, I guess, right? So this is it for now. Now let's have a look at the stock market, and then again we will try to wrap up things for this weekend as well. Now, in my view, from a technical standpoint, there is not a lot to say about the stock market. I mean, if you look at the heat map for the week, what you see is that essentially, even at the first glance, right, what really drove the market higher for, I mean, not only this week, but most likely the last month and a half, it was the tech sector, right? So technology, semiconductors, all those things. So, you know, that would be the main driver, obviously. And, you know, you look at the rest of the market, like financials, they're mostly red for this week. Consumers, goods, red. Utilities, red. Transportation, red. Industrial, kinda reddish, more or less. Healthcare, neutral, right? But all the rest, you know, energy, and then what? Consumer services, communication, it's all red. So the heavy lifting, once again, was done by these guys right here, right? So when you look at the market and you look just at the index, right, or the indices, I mean, pretty much both the S&P and the NASDAQ, they just had a little bit of a consolidation on Monday. And if you zoom in, you can see that what we did essentially was just rebalancing the up move from the previous Friday, right? In here. I was curious because there were two lows, right? The first one was put in the London session. You know, then cash hours, US session, another pullback, really filling in all which was left to be filled, right? And then up we go. Tuesday, Wednesday was just an up market. Now, interestingly, if you look at the Dow in here, you see that, I mean, the pullback was way deeper. Then again, I mean, eventually it came back up. It made a new high relatively to previous Friday, sure, previous week for the Dow, but wasn't to the same magnitude. There is not the same dynamic expansion and sharp expansion that you're looking at in the NASDAQ and the S&P secondarily, right? So, I mean, yeah, Thursday saw a little bit of a reversal attempt. As usual, Thursdays are good days for reversal attempts or, you know, dumps. Obviously, in these market conditions, it's it's kind of hard to think a full-on reversal. But yeah, just a pullback, bro, right? And again, look at these pullback, both for the S&P and the NASDAQ. It was just basically a pullback into what? Some previous day structure, right? Both in here and in here, right? So, you know, you can't fight this tape for now, not yet. The market, when you look at the two main indices, on a Friday, it also closed relatively near the current highs for the day. So again, it's another point of strength for these markets. If you zoom out and you look at the daily, I mean, look, just a thought, all right? This is crazy shit, right? I was reading, I think it was an X, and it was along the lines of, if you didn't experience the .com, now you can trade something very similar to it. And again, .com, markets going crazy, up only, right, type of moves for months at a time, right? And I get back to the same type of debate, right? Because you got people saying, oh, well, we are categorically in a bubble. Are we? I mean, maybe we are, but the thing is, for me, beyond the simple definitions of bubble or not bubble, but it's kind of the same old topic about psychology. Like, if everyone thinks, or the vast majority of people, or participants think, we are in a bubble, well, what are they going to do? Most likely, they're going to try to hedge themselves in the case that the bubble pops. How do you hedge yourself? Either you buy puts, so you use options, or you open shorts, or maybe you buy an inverted ATF, something like that, right? But you need to express a position which is basically short relative to the market. And what happens when the market keeps on grinding higher? All those guys will need to basically close down their edges, buying back those positions, which in time does what? Fuel farther upside when it comes down to price action. So I think, the argument that we are in a bubble is sure. And look, are we in a bubble and everybody knows that? So it's not a bubble. If everybody knows that, it's not. It cannot be. It cannot pop. I do think it would actually be a bit more scary when you have pretty much everyone, even the perma bears, getting all of a sudden bullish. Oh, there's no risk, man. You should just buy every single day. The market only goes up. Look at that. There is no short interest up there. Puts volume are below the floor, not on the floor, but below the floor, right? Nobody really feels the need to hedge himself. I think that's where the market is much more, vulnerable to sharp pullbacks. Now, will it be the pullback which, send this market to the next bear market? Maybe, maybe not. It could be just, again, another 10% pullback, and we keep on climbing higher 1-2 months later on. But to think that we are in a bubble, and all of a sudden everybody should know that we are in a bubble and they're not doing anything against it, how can the bubble pop? Right? If everybody knows that. So that was some funny thing I read. Other than that, I mean, clearly these markets are getting a bit ahead of themselves. Maybe, yeah, they are getting a little bit ahead of themselves, sure. But look, I can't be bearish. It doesn't matter what you throw at me. Like, valuations are too high, sure. Market is too crazy, sure. There is too much complacency, sure. And then what? I don't see this momentum yet being faded. And again, like this week, that tiny little bit of divergence we were looking at on a SPY, it went away because we made new highs and the indicator made new highs. We were looking at a MACD which was kind of slowing down if you look at Instagram, and then you see what? It's kind of reaccelerating now. Look at the moving averages. They were almost touching each other, and now this week it looks like they're kind of running away from each other, both for SPY and the Qs. So again, I think trying to call tops and bottoms, it's a fool errand, right? Look, when the market will put in a top, you will know. You won't have to guess, right? There will be many different things telling you. So first of all, it will be the market. I mean, look at that. Tell me how many times when you zoom in, right? How many times you see a candle, daily candle, actually trading below the previous daily low? Doesn't happen so often, right? And even when it happened in the recent past, it was basically doing what? Retesting the faster moving average we can think of or we can use in this setup and using it as a launchpad to keep on rallying. So I would say, in order to call a top, first of all, you need the market to actually start breaking lows, previous daily lows. Then you would need it to stop bouncing off of this moving average, which is, I think I don't ever remember if it's an 8 or a 9. But again, it is what it is, right? So breaking below it, closing below it, retesting it from the above, from below, and being rejected. And then in time, you should have the moving average flattening and then starting to be down slope, right? So look how many things should happen before you can call a top. Now, again, it's all well and good to say, I don't want to participate at these higher levels. I wouldn't buy these higher levels in the market. Okay. Actually, I feel like I should de-risk a little bit. Okay. But God forbid you shorting this market now. Okay. That's my main point. Same as last week, right? Now, I'm not saying, again, and I went over it 2-3 weeks ago, I'm not saying there are no risks in the market, right? The problem with the risks is always the catalyst. It's always the timing, right? And the usual talks about the market, which can keep on being irrational way longer than you can stay solvent, yada, yada. So look, trade the market you have at the very end of the day. It's kind of the same as last week because the market is behaving the same, right? But don't discard the fact that there are risks building up, right? That's for sure. I'm not saying they're not. So for instance, one could be, and again, we were looking at these last week as well, that the market throughout this rally, the breadth is narrowing down. So we were looking at the heat map before. You look at the equal weighted index now relative to the S&P, no new highs in the equal weighted index. So the rally, the bulk of the rally, it's sustained by less and less stocks or less and less sectors, which in time would make the market vulnerable. Maybe, unless we see another rotation and the market just goes sideways for a while instead of crashing, as many people on YouTube are expecting. And this is another thing. I keep on seeing all these videos with the thumbnail, the next 50% drop, the next 40% crash, the next dot-com bubble, the next GFC 2.0. Huh. And then what? I don't ever see something like that materializing itself. All right. And even in recent history, right? When it was a story about tariffs, what you've seen, 15% decline, up we go. Now we've been talking about AI being too expensive, AI being in the bubble. The market drops like a 10, 12%, and it goes up to historic new highs. It's still a buy the dip market, whether you believe it or not. And as scary as it might be, right? Now, if you start to look at that, okay, so you look at volatility, so you look at the VIX, 17, to me, that would indicate a bit of complacency, right? So when the VIX hits, think about the VIX, it can only go up or down, right? So if it's massively up, usually that's a good bottom. If it is, suppressed, at a point, it should expand to the upside. And that's usually when you see a decent pullback in markets. So a VIX which has been suppressed for a long, long time, it gets you closer and closer to the next short-term top, pullback, you name it, right? Then, you can look at the money flows, right? It looks like all these run-up was matched by new money getting in the market. Now, if you zoom in, let's get rid of the RSP for now. If you zoom in, what you see is that over the last few days, these farther run up, you see money flows start to, ticking down a notch. It's not huge, but just a tiny bit. So again, maybe a little bit of an exhaustion. You're looking at SPY here, so maybe, but when you look at the Qs, it's flatlining, it's not dropping, and the market is keep on pushing. So again, market concentration risk for sure. Breadth problems. Sure, I get it. But again, I keep on revolving back toward the timing. And I don't know, I'm a broken record, but I've been trained to not try to time the market rather than trading in line with the market, right? Now, we are in May now. Am I right? Yeah. So just for the sake of it, we got the stats, the huge Wall Street adage from the old days, selling May, go away, right? Now, if you look at statistical evidences, $10,000 investing in the market, there is this comparison in between the May to October period, which should be the weaker period of the year, versus the November to April period, which should be the strongest period when it comes down to return. And again, historically, it doesn't mean that 1 year or 2 years in a row it could be different, but historically, this is what we got from the late 50s, early 60s, right? I mean, stats are stats, right? Believe it or not, you can use them or you can just discard them and say they don't count shit. Obviously, if you just look at them and saying, you know what, but I do remember 2021, it wasn't such a bad April, right? Or May. No, it wasn't. But 22, I guess it wasn't a good May, right? So you need to look at these things over a long enough period of time. Otherwise, you're just imposing your own short-term view on long-term data. But it's still something which is worth noticing, right? As everything with seasonality. Seasonality can be defeated, absolutely, sure. But we are going into the summer, especially as we were discussing last week, not really June or July, but maybe August, September could be good months for a decent pullback in markets from a seasonality standpoint, right? And then, after that, still presidential cycle, election cycle, so tends to be a bit weaker throughout the summer because, of course, uncertainty about the elections. And then when all it's cleared out, we may keep on rallying in the strongest period of the year. So after October, November, December. But so again, you could throw this one at it. So another risk for the summer, right? Then you got what? Average intra-year drawdown. So you see that still potentially this year, a midterm year, it's one of those where you basically recorded the highest degree of drawdown if it comes, right? So, it's just another data point, all right? So for the summer, there are a few risks. So seasonality, the presidential election cycle type of risk. Then, of course, you got a bit more of them. The divergences. We have been looking at, a lot of sectors being left in the dust and just a few doing the heavy lifting, market breadth. And still, we got these oil shock, the energy situation still looming because we don't know what's going to happen, right? Is the strait closed, open? Who the fuck knows? And most importantly, even if it opens back up tomorrow, how long before, the flows of oil get back to normality? And how much damage has already been done to the global economy, which is not materialized yet, but it will in the future. And what about fertilizers? So what type of situation we will see for food, crops harvesting, food inflation, right, in the coming months? It's not something you're seeing now, but maybe, who knows, come September, October, who knows, right? So again, just because I think, and I look at the charts and I say, don't fight this tape, that doesn't mean that I'm completely discarding the risks that we may face from 1, 2, 3 months, right? So just be aware of that, okay? But it's undeniable that what you're looking at for now, K-shaped economy, we were talking about the labor market, but what's really driving not only, the economy being resilient and the stock market, streaming higher, is that if you look at personal consumption, you remember I always told you, look, consumption, it's really important, especially in the US, because it is an economy which is 70% consumption when it comes down to the global overall output of the economy of the country. Sure. So you see personal consumption going down. You see 10-year average, 1-year average, in Q1 2026, right? So recent times, it's going down. So consumers, are they a bit tapped out? Are they pulling back a little bit? Are they worried? Again, Michigan Consumer Sentiment Index down the toilet, right? Sure, yeah, they are. But what is offsetting that? Business investments. So basically, it's the AI build out. All these companies, CapEx, those are real money being put into the economy. Those are real things which have been constructed. Those are real jobs which have been created to build up all these infrastructures, right? That's real demand, which is hitting the market, right? Again, if you look at the real estate, still a drag, all right? We have been discussing even last week, after the shutdown, rebound in government spending, we were looking at the export versus import situation. And again, because of the oil shock, most likely a lot of people would just front run what they fear it could come afterward. So, all in all, I think at the end of the day, it's a very simple chart, but it can explain maybe why you don't see that, collapse, quote unquote, collapse in the economy that many people would have expected. Not only now, but even 2022 and whatnot. But now it's much more related to what's going on in the Middle East, right? So there is this huge offsetting factor for now, okay? So it is all, rosy. It's the glass categorically half full. I mean, look, if you look at that, right, what you see is that a lot of sectors are actually not participating, right? Again, we get back to the heat map we were looking at before, okay? So, but, up until the point you don't see some cracks showing up in semiconductors, tech, and all the rest, communications, maybe to some degree, although a much lesser degree, in my view, right? Up to the point you don't see that going, it's hard to see these markets as a whole, like the index, really pulling back, right? So, if you look at these measures, right, right now, tech, it's massively overbought, sure. Many other things are kind of neutral. And of course, you have healthcare being massively oversold, all right? But, nothing tells you that when you will see, and again, at a point, you'll see it, just rewind back to 2025, October, November, almost getting into December. Do you remember what was going on? Nobody wanted tech. Tech was AIDS, right, essentially. It was too expensive. There were no profits on the horizon, so all the spending was for nothing. And then what? So it take a bit of time, but these markets do rotate, okay? So the next rotation may be money coming out of technology, transportation, and energy, right? Getting back to what? Financials, healthcare, materials, maybe, who knows, consumer discretionary. Because think about it in these terms. If you have, for some reason, right, I don't know, but this should be the catalyst. We don't know where, we don't know how, we don't know why, but this could be the catalyst. The war is over in the Middle East with whatever deal they will come up with, when they will come up with, we don't know. But let's just face the fact that at a point, this shall pass too, right? Oil may pull back, and at that point, all those sectors which are impacted from higher oil prices or the fear of even higher oil prices, they will rebound. So, consumer discretionary, right? For instance, utilities, right? Consumer staple. Real estate, which could be impacted by, second order effect, like higher energy prices, that AKA higher for longer rates. sure, real estate would be better off if rates could go lower, right? So again, I think there will be another rotation, and you will see it playing out, right? It's just a matter of being prepared for it, right? And again, if the market rotates, right, and you have a huge pullback, say in tech and semiconductors, will you have a pullback overall in indices? Absolutely yes. Will it be a crash if, money's not leaving the stock market completely, just rotating to different sectors? Probably won't be a crash. It will be an organic pullback, which may be a good buying opportunity, actually. And again, you start to pair it up with the timing of it. Summer, midterms, seasonality, right? So, you need to start to think about these scenarios in advance in order to be ready to capitalize on them when they happen, right? And again, to close in on this bubble, not bubble type of argument, just, look at these. The differences are pretty evident for me, right? It's not just a matter of, price behaviors, right? It's some other fundamentals, right? We got the same conditions. Both indexes are going to the same direction, which is up, massively up. There are a bunch of stocks, a basket of stocks driving them higher, right? And there are the same type of, worries about how it could end and when it could end. Okay. But the thing is that, we might have a little bit of a rotation, not a breakdown, rather than a huge crash like it was in the .com. So again, not only we don't know if we are still in 1999 or we are already in the 2000s, but there are a few nuances here and there which could play a big role in deciding whether this is going to be just a major pullback to buy or a huge crash. And for now, I don't see the argument for seeing a huge 30, 40, 50% crash ahead, right? So that would be it for me. Keep on staying long, keep on, at least, long biased. I'm not saying keep on opening new longs at these levels, right? But, day trading at this point, I mean, even a monkey could do it. Oh, I mean, market pulled back what? 30 points. I'll just buy it. Are you sure? I mean, buy it, pulled back 30 points. Probably. I mean, over the last few days, it went up on average 200, 300 points per day. So if it pulls back 30, 40 points, just try to buy it blindly. I mean, if it bounces even 40, 30 points back, you already made money. So it's the most stupid market ever. It is so easy, which at the same time, it should ring a bell, right? An alert somewhere. But up until the point it lasts, and it goes like this, I don't see any reason to try to fight it, right? So again, that would be it for me. There is not a lot. I mean, unless you want to look at some individual stocks, but I mean, the video is already too long. So just for the sake of it, we were talking about the heavy lifting being done by tech. Look, if you check, the Mag 7, like Apple, right? Amazon, Google, Meta, not so much. Microsoft, not so much. Nvidia underperformed for a good chunk of time. Now it made new highs, finally. All right. Tesla, kind of going nowhere. So these run up. It wasn't even the Mag 7, which delivered that. It was what? AMD, RM, ASML was already going up, but there are a few charts here which are absolutely mental, like Intel, right? Micron. I guess the other one. Oh, look, memories. Like, look at SanDisk. Look at Western Digital, right? So, sure, it's tech. It's not necessarily the Mag 7. It looks like, for now, it's not only about AI, but it's all these guys selling the tools in order to build up AI. It's like to go back to the the gold rush, right? Who were the people making the most money? Those actually seeking and finding gold, or those selling picos and shovels, right? I think we are living through a similar type of historical circumstance. And, again, the point I see, or, the point I don't see in calling a top in here is that who tells you that when money will come out of Western Digital, SanDisk, Micron, Intel, all right, AMD, because now you got the story about CPU makers. It looks like they joined the run because, up until this point, it was all about training these LLM models, right? Now the sector is working on creating these new, I'm forgetting the term, these new agents, right? Which, in order to function, they do rely a bit less on GPUs, but they do rely a hell of a lot more on CPUs, which is why you're seeing this week like a partnership in between Intel and Apple. Therefore, Intel should deliver the chips that Apple will use for Apple's AI. So, they're playing catch up, these CPU makers now. The thing is, all right, let alone the fact that after a run like that, at a point, money will rotate out. The point is that when you look at margins, a corporation like NVIDIA still retain a huge 75% margin on what they do produce. So the margins that you can realize by selling GPUs, it's still higher than what you could realize making CPUs. So fundamentally, profit margins for NVIDIA, therefore earnings and revenue growth, should be still projected higher relative to Intel or AMD, although they are playing catch up, right? But when money will rotate out of CPUs or semiconductors to go back into the Mach 7, who tells you that it won't be just not only a rotation from one sector to the other, but a rotation inside the same sector, which will have, at the very end of the day, the same result, keeping the technology sector as a whole strong, therefore the Qs strong, and the Qs are reflected, a good chunk of them are reflected in the S&P, and therefore even the S&P will keep on being stronger. Who knows, right? But I think those are all legitimate questions you should ask before calling a top or calling the market defeated, right? Now, again, really long video. I apologize for that, but there was a lot to be discussed, I think. Or at least I got a lot on my mind this week. Might be because the market was so easy that I had time to think about other things to just fill in the time, right? Who knows? But with that, I'm going to leave you off, wishing you a very good rest of your weekend. And as usual, be cool, be nice, whatever you want to be. And we'll chat again next week. Niels out.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.